Hello everyone. Today we're going to be looking at a marginal costing question, which again is a question 8. So generally this will either be marginal, absorption and marginal, or you can have something that's product costing, first in, first out, stock valuation. So there's a lot of different things that can come up. Generally there's an absorption, and then every now and then it can be a full marginal or it can be half and half. So I guess it's one of those questions where it's quite, you just really don't know what will come up in what year, but the more you cover then, the easier anything that comes up will be. So how do you lay this one out? Well, this one is a pre-Leaving Cert exam paper from 2010. So there's not loads of marginal questions out there, or full marginal questions anyway. So what we do is we read the question for 2 or 3 minutes. So we have the company produces a single product. The company's profit and loss account for the year ended the end of 2009. We had 38,000 units were produced and sold. And we have this. So we have our sales, we have material, direct labor, factory overheads, admin expenses, selling expenses, and we're given the net profit. So we have to ensure that when we're redoing this table to break it up into variable costs, fixed costs, and then per unit basis, we have to make sure that our net profit will lead to this. So this is actually an anchor that we have to ensure that we get that figure essentially. So we're told that the materials, direct labor, and 20% of factory overheads are variable costs. So that's this, 20% of this, and then we're told apart from sales commission of 5% of sales, selling and admin expenses are fixed. So selling expenses, we have commission of 5% on the selling price or just total sales. So we'll have again a per unit basis and a absolute or like euro figure. So then that leaves that selling and admin expenses are fixed. So whatever is left from the selling expenses, so let's say the total selling expense is 80,000, X amount will be commission, so whatever is left is fixed. All of the admin expenses is fixed, and 80% of the factory overheads are fixed. And that's that. We are then required to create the company's break-even point, margin of safety. Then we're given kind of equation questions from B all the way to E. So if you're quite good at maths, adding, multiplying, dividing, kind of logical thinking, they're actually nice questions and you can get them done quite quickly. So before we do any of this, we have to reproduce our profit and loss into euros and units. So here we have just a small little table, something that's really easy to create. So this is for units, 38,000. So just we'll have to use that to get our per unit basis. So we're told that sales is 1,398,400. So 1,398,400. Then as part of variable costs, we will have materials, direct labor, we will have factory overheads, we have sales commission. Now, what I'm going to do here is I'm going to keep sales commission separate to the other variables because our variable costs here, the first three, will not change when we get down to some of the equations. So when we get down to some of the equations, we'll have a different selling price. So we see for E, we have to find the number of units that must be sold at €32 per unit. Then in part D, the selling price the company must charge per unit in 2010. So we don't know the selling price, which means we also don't know the number of sales commission we have to pay out. Then we're told the profit the company would make in 2010 if it reduces its selling price to 34. So there's 3 different figures for S, or selling price. So the easiest thing to do is, we know that the direct labor, materials, and factory overheads will not change with selling price changing, whereas sales commission will. So we'll have to keep that separate. So the materials is 475,000. Direct labor, 326,800. Factory overheads is 26,600. So that is a total 828,400. And then sales commission is 69,920. So how did I get that? I did 5% of 1,398,400. The factory overheads is 20% of whatever the total is. 133,000. And then they're just the total figures. So then the total variable costs, which we're not really too bothered about, can be written here, but all I'm going to do is I'm going to take both of these figures away from the sales to get my contribution. So sales minus variable costs is our contribution, which is 500,080 euro. Now we're going to get the per unit, so I'm going to divide 1,398,400 and divide that by 38,000, and I'm going to get 3680. I'm going to get all the variable costs without taking into account sales commission, which is €21.80. I'm going to get €1.84 for sales commission. Contribution per unit is €13.16. So we need to know all of these things going forward. Now, what are my fixed costs? We have factory overhead, which is now 80% of 133,000. We have selling expenses, which is going to be less sales commission. And then we also have admin expenses then as well. So the admin expenses are whatever figure we see we'll put in. So 93,900. Sorry, it's easier probably to put it here. The selling expenses are 10,080, and the factory overheads 106,400. We're going to total them all up. So the total there is 210,380. That means our profit then is 289,700. So 289,700, 289,700. So at least we know now we're in the right place. So now we can do a break even. So it doesn't tell you that you must do that, but by creating this, it will make all the other questions or our life so much easier. Now, the other thing I like to take a note of is this formula. So we have sales minus variable costs. Now we're going to exclude sales commission. Then we're going to minus our sales commission. We're going to take away fixed costs. And then that's going to give us our profit. So all it is it's turning the table form into an equation. So what do? We have our sales. We take away our variable costs without sales commission. Then we take away our sales commission. Then we take away our fixed costs, and then we get our profit. So it's just turning a table form into a nice simple equation to make things easier for us when we do part B, C, D, E. So, but that's not what they're asking us for. They're asking us for the company's break-even point and margin of safety. So I'll just create a new page and we're going to do the break-even point. So logically, what does the break-even point mean? Well, the break-even point means how many units you must sell in order to cover your fixed costs. Or sorry, to cover all your costs. So if you look at it this way, you know that your contribution is your sales minus all your variable costs. So the contribution, €13.16. So every unit I sell, I make €13.16 if we don't factor in fixed costs. Or every time, once we have covered our fixed costs, I will make €13.16 every time I sell something. So all this is saying is, how many units must I sell for this 13.16 to cover my fixed costs? Then anything after that, I'm making €13.16. So, or 210,380 divided by 13.16. That will give me 15,987 units. Now, I'd always get the sales we must also make. So we know that €36.80 is our selling price. So if we have to sell 15,987 units at 36.80, that means that we must generate sales revenue of 588,296.66 in order to cover all our fixed costs. Now, the margin of safety is basically saying, well, what are the sales we have this year versus our break-even point? So that means like how much in the clear are we? So we're going to get that again in units and absolute. So we have 1,398,400. We're going to take away our 588,296.66, and we're going to take away our 15,987. So in terms of units, from 38,000 units. And we'll get a euro figure, and we're going to get a unit figure. So here we have 810,103.34 cents. We have 22,013. So what is this telling me? So if you were a management accountant for a firm and you were doing something like this, you're saying, well, looking into the future, we have to sell 15,987 units each year in order to break even, to make sure that we're at least making some sort of a profit. Or sorry, we're at least not losing money. We're not making money, but we're not losing. Then you say, what is our margin of safety? So how well did we do last year versus our break-even point? So how much in the clear are we? Well, if you think about what we at least have to hit, which is 588,000 and change, we hit 810,000 above that. So it's quite good. Then you're saying, well, the minimum amount of units I must sell is close to 16,000. We sold 38,000, so 22,013 units is how much further we are from the break-even point. So they are good metrics to use. So that's A. Not too long if you're not, I guess, explaining it as you go ahead. Now we're going to do B. So I'll just zoom in a bit. We are told to find the number of units that must be sold in 2010 if the company is to increase its net profit by 20%. So there's a few things here. we're looking for the number of units that must be sold. That means then that our variable, so if you think about maths, our variables are normally x's and y's, is going to be u, or the number of units. What has changed? Well, our profit has increased by 20%. So that's 289,700 at 120%, or 1.20. They're the same thing. So that's what we're looking for part B. So if I go now to B, I'm going to use this formula, and we're going to do, what's my sales? So we're looking at it per unit. We don't know the unit. So that means we have to use our unit pricing. So the sales was 36.80 by U minus 221.80 again, we don't know the units, minus 184. We don't know the U. We do know the fixed costs. It's 210,380. And we now know the profit. So there is our fixed costs. We want to get 289,700 by 120%. So this is just a contribution because we haven't changed our selling price. So we also haven't changed our sales commission. So I can just use our contribution figure of 1316. So 1316 U. I'm going to move all the constants, so stuff that won't change, or that's the absolute values. So 289,700 by 120 is, I'll get it there now, 346,000. Sorry, 347,640. If I'm bringing that over to the other side using my stabilizers, I'd have to add that amount on each side. So if I add 210,380 on the left hand side, it will cancel out. If I add it to the other side, it has to be added. So 1316 U equals 558,020. We have to divide both sides by 1316. That cancels out with that to give you U, and you're left with 42,403 units. So that wasn't too bad. So what I'm saying is, I guess, whenever we just need to find the units and the selling price doesn't change, we can use contribution. If we do change the selling price, we have to be able to segregate variable costs and sales commission. We must segregate them. So what is C? I will rub this bit out. We are told the profit the company would make in 2010 if it reduced its selling price to 34, increases its fixed cost by 12,000. So fixed costs are now going to be 210,380 plus 12, which is 222,380. But the units are 41,000. So we will do that here. So we do know the selling price. It is €34 by 41,000 units. minus 2180 by 41,000. Now be careful about the sales commission. So we know that it's 5%. Sales commission equals 5% of €34 now, which is going to be 170. So the sales commission is now turned into 170 by 41,000. So you can see there that it has decreased with sales commission. Or sorry, sales commission has decreased with selling price. So we always try and segregate variable costs and sales commission. Just the easiest way to do it. And we said that the fixed costs increased. And it says all other levels and percentages remain unchanged. And we have to find profit. So if we put that into our calculator, what we'd end up getting, I guess, is we can put all these together if we'd like to get a whatever multiplied by 41,000. So 1050 by 41,000. So I've just merged all of these together. Now you could easily just put that in your calculator. So that's 43500 less, which is 208 120 euro. So yeah, that's that, no worries. There shouldn't be too much of an issue there. And now that we know that and the formula, we can easily do part D without any kind of struggle. So we are told the selling price the company must charge per unit in 2010 if fixed costs are increased by 10%. So again, the selling price I'm just going to call S, so this is our variable. That means that sales commission will also have a variable of S, but we know that it's 5% of selling price. The fixed costs are increased by 10%, but the volume of sales and profit remain the same. So sales or the volume of sales, so we still have 38,000 units. And profit will remain the same, so 289,700. Fixed costs will increase by 10%. So that is 200. What is it? 210.38 by 1.1 or 110%, which is 231,418. Sales commission is 5% of selling price, and we can do that now straight away. So again, S is my variable. I'm selling 38,000 units. My variable costs will not change. It's 5% of selling price at 38,000 units. The 231,408. 231,418, and the profit remains the same. So we have to find S. So if you think about it, what I'm going to do is I'm going to combine the sales and the sales commission. Okay, because they're both the same variable. So if I have one S and I have to take away 0.05S, what I'm left with is 0.95s multiplied by 38,000. So what I'm saying is now you don't have to do this, but I'm combining this and this. Again, quite mathsy. I'm going to create a variable cost straight up. So 21080 by 38,000 is 828,400 minus 231,418. So if I bring all of these over to the other side, I'll get 1,349,518, and if I multiply 0.95 by 38,000, okay, so selling price, you divide 36,100, and that makes the selling price €37.38. So this is probably one of the hardest, the actual getting the selling price, especially when we have to factor in sales commission. So we could have easily just did, left all the S's to one side, left all the numbers to the other side, and we would have eventually got the same 36,100s. Yeah. So just be careful when going through this, and definitely if you are struggling, just rewatch the video and try and do the question yourself. So that is part D. Now the last one before theory is part E. So we'll do that now. We have to get the number of units, so our variable is now U again, that must be sold. The selling price is €32 to provide a profit 10% of sales revenue. So this is tricky. So what we're saying is our profit must equal 10% of sales. So that would then mean that the profit would have to equal whatever the selling price is, €32, by however many units we sold by 10%. So that's 3.2 U. So our profit is going to be 3.2 U. Fixed costs are going to remain the same, but sales commission is going to have to equal 5% of selling price. So 5% of 32 is 160. So this is what makes it quite tricky, is there's just loads of things are changing. Again, not the hardest thing in the world because we know our formula. We just have to make sure that we're getting all the figures correct. So we said selling price is now €32 by however many units we sell. Variable cost does not change when we exclude sales commission. We have changed sales commission to 5%. Fixed costs remain the same. And we said that the tricky bit is that profit is 10% of the sales revenue we generate. So that would have to be the sales revenue is selling price by number of units. So the profit would be selling price by number of units at 10%. So if I put all the U's to one side and the constant to the other side, that means we get 210,380. So we have 32 U minus 2180 U minus 160 U minus 320 U 32U minus 2660U. So this is just all of these bundled together. And then we have €5.40 U. So our basically what we now need to do is just divide. And the amount of units we must sell, 38,960. So we would be quite close to the number of units we're selling now. We're selling 38,000 units. Now, not the hardest thing in the world, especially when you look at fixed or financial accounting. What's really important is that you set yourself up for to succeed. So your layouts are good, you know. So you're going from a selling or a profit and loss account like this, something very small, and you're going to turn it into sales, variable costs, contribution, fixed costs, profit. You're getting your euro values and your rates per unit. You then remember, you're basically turning it from a tabular form into an equation: sales minus variable costs minus fixed costs equals profit, but you're just segregating variable costs and sales commission. So even though they're obviously both variable costs, you're going to segregate them because your sales commission will always be a percentage of sales. Now, there could be other cases when it's not when sales commission isn't a percentage of sales, but it's actually a cost per unit, where then it wouldn't affect sales commission, that wouldn't affect the sales price, but they don't come up as often. Now, looking at the theory. So like, you set yourself up there, even though this isn't in the question, that is the most important. It makes doing the break-even point, margin of safety easy. It makes your equation life easier as well. And now as I said, the theory. So I will get up the answers that they had in the marking scheme and kind of go through them to make it easier, so you know yourself what they're looking for. So 15% or 15 of 80 marks were going for theory. That is almost 20%. It's what, 18.5% or something like that. So theory is super, super important, even though you don't actually need to give that much. So like, it's so important to theory. We have to outline 2 limitations of marginal costing. So why doesn't marginal costing always work? Well, not all costs are easily categorized as fixed or variable. That is true. So if you looked at factory overheads, we said that 20% of factory overheads are variable. How do we know that? Maybe this year it's 20%, next year it's 30%, but we're always going to use 20%. Then obviously if we're selling 10,000 units or 100,000 units, so like, it's not going to make a huge difference if we're always around the 38,000. But if we change 10,000, it will have a drastic effect what we consider fixed and variable. If we go to 100,000, it will make a huge difference between what we consider fixed and variable again. Fixed costs are only fixed within a relevant range. So this is where we have our step costs, we call it. So we kind of have, let's say, or cost and a unit. So let's say if we make 10,000 units, it's going to cost us, I don't know, 100,000 in fixed costs. So whether we create 0 units or 10,000 units, it's going to cost 100,000 because we only need one warehouse. Then if we make anything over 10,000, we'll have to buy a second warehouse. And let's say that will only last until I get another 20,000, etc., etc., etc. So the step costs aren't taken into account when we do marginal costing. Variable costs are assumed to be completely variable at all levels of output. So what are some of the things that would change? Well, we have economies of scale. So what are economies of scale? It means, okay, If I have a supplier, he will say, I will send you 100 planks of wood and it will cost you €100. If you buy 1,000 planks of wood, well, the delivery will be cheaper because I can create more. I can sell them onto you for a cheaper rate as well. So let's say 1,000 would then only cost you €900. So it's going from €1 a plank to 90 cents a plank because you're buying in bulk. So we see these with the likes of Lidl, Aldi, and there's loads of other places. I guess any kind of manufacturing, the more things you buy, the cheaper it will become. Economies of scale. So we don't factor into economies of scale. We said that variable costs, if you take out sales commission, will always be the same no matter how many units you sell, or the rate will always be the same. So they're actually nice questions. What are the limitations of marginal costing? Because they do make sense. So any two at 3 marks each. So that's what this means there. Explain with an example what is meant by the term sensitivity analysis, and then you have to give an example as well. So explanation. So sensitivity analysis is used to study the impact of changes in costs or revenue on profit. So simple for 5 marks. Crazy. So what is it? It's used to study the impact of changes in costs or revenue on profit. So you're kind of saying it's basically what we were doing in the marginal costing question. You're saying if I change the number of units, how will that affect profit? If I change the amount of fixed costs, how will that change profit? If I change the selling price, how will that change profit? Then you just give an example, which is exactly what I did there. What would happen to profit if we increase the selling price by 20%? Like, so easy for 9 marks. That's over 10% for 2 sentences. In my opinion, it's not fair that you could do very well in the practical and then lose so many marks because you don't have your theory. But at the same time, there's only 2 lines you need to learn for that. So that is the end for the marginal costing. I hope it makes any sense. If you struggled with any of it, I would recommend going back over the video, maybe slower or even quicker, depending on how you like it, and really kind of digging into the equations and seeing how I did the equations. Because if you can do that, then your marginal costing questions will go super quick. If you can do these quickly, it means that you have more time for the question 1s, your questions 5, 6, 7, which will, the quicker you do the management accounting, the more time you have for the financial accounting, which will give you more time in the exam, should bring up your marks as well. So that's the end of this. Thank you very much for watching, and I'll see you in the next video.